Good morning, everyone. I'm Neil Barclay, Chief Executive of Meridian, and I have with me Mike Roan, our Chief Financial Officer. Thank you for joining us for our interim results presentation for the 6 months to 31 December 2019. We're really pleased to present a record interim result with the EBITDA up 20% on the prior year and net profit also lifted by 26%. To sum it up, the business has been buoyed by relatively high wholesale prices and significant hydro inflow events. But both of these factors create risk as well as opportunity. And I think we've managed the conditions exceptionally well. Meridian's near-term portfolio management has been very good, and our ability to win new customers at improved prices has really made this result. Last year we shared our strategic themes with you, and these two charts address our progress against these. I'll make some general comments now, and we'll touch on most of these themes throughout the presentation. The electricity price review concluded with a range of initiatives that we think on balance will improve the operation of the market, particularly as it affects customers in hardship. We also applaud New Zealand Parliament's progress in establishing bipartisan support for climate change legislation that will deliver a zero carbon New Zealand by 2050. That said, we're yet to experience any real demand traction from decarbonisation efforts, so the policy settings are in place, but the real hard work needs to commence. Our retail businesses in both New Zealand and Australia have real momentum. We've grown customer numbers, volumes sold, and overall contribution from the segment across both markets. As I said earlier, this is underpinning the strong financial performance of the group. While relatively high wholesale prices are boosting our generation business at the moment, I'd argue that shows the market is operating as designed, and as a result, we're seeing new generation being built, improved market confidence in gas supplies, and transmission enhancements. Now, it may take some time, but we expect these factors will translate into lower forward prices. We remain very focused on our own development options in New Zealand, but clearly competition is hot. We also have renewed our efforts to build our development pipeline in Australia, and we've added a wind farm option into the hopper. However, given current valuations, acquiring high-quality development options in Australia will be challenging in the near term. Now, if we think it's tough retailing electricity in New Zealand and Australia, and we do, it's a breeze compared to the UK. We see this firsthand with our partnership between Flux and npower. The retail sector over there is bleeding cash, and large players are having to find ways to slash costs. A small example of that is Eon's decision to suspend deployment of a new Gentrack billing platform and instead focus on npower's integration. And amongst the npower-Eon merger uncertainty, we have agreed terms to add another 200,000 more npower customers to the Flux platform by December of this year. So we remain part of the consideration set for Eon UK's future business, but we do acknowledge we're a very small cog in that wheel and we won't get carried away with ourselves. Now, I'm sure what most of you want to hear about is Rio Tinto's impending decision on the Tiwai Point aluminium smelter, and I will talk to that later in the presentation. But for now, I'll hand over to Mike, who will run through the financial result in a bit more detail.
Thanks, Neil. During the 2019 year-end results call, we advised you not to expect another result like last year, as the events and environment were unusual in our view. We'll wind forward to today, and through the first half of this financial year, we've outperformed the comparable period in FY2019 by a considerable margin. So I guess our direction was a little off, but we were trying to be straight up with you, and we definitely didn't see the wholesale prices extending as they have. More on this later. So we've had a tremendous 6 months. Through the first 6 months of this financial year, and as Neil mentioned, EBITDA lifted by 20% to 465 million, and net profit after tax lifted by 26% to 191 million over the same period in 2018. And what makes this result remarkable is that the first half result last year was a record in its own right. Execution in New Zealand in particular was outstanding, and while our Australian activities could benefit from some rain, like most of Australia right now, the customer side of our business across the ditch drove remarkable growth. Anyway, on to the numbers. So what do these results mean for our shareholders? It means we can maintain our FY2019 interim ordinary dividend payment of 5.7 cents per share and top that up with a capital management program dividend of 2.44 cents per share for a total interim dividend payment of 8.14 cents per share. A repeat of the FY2020 interim dividend seemed like the right approach, given we have considerable uncertainty in front of us in the form of an announcement from Rio Tinto, and we didn't want to signal in any way that we had information as to how that decision might play out. As you'll hear from Neil shortly, we do not. At the August results call, we also said we'd provide direction on the capital management program. In particular, we intended to update you today on whether that program might be extended. However, things have changed, so we're deferring guidance on that until later this year. I will say that sitting here today, and with the result for the past 6 months playing out so strongly, our financial flexibility is stronger than we had expected, but it makes little sense to provide direction or further direction on either ordinary dividends or the capital management program until we understand Rio Tinto's decision. On to the driver behind our results, net revenue or energy margin in New Zealand. As you can see, energy margin was up 88 million compared to the previous period. And this increase was really powered by growing customer sales revenue that lifted by 79 million or 25% over FY2019. If you look at the slide, you'll see that sales revenue in the residential, small business and agri segments improved by 30 million over last year. This was attributed to increasing customer numbers as sales prices to those customers remained flat year on year. At the same time, we saw a 49 million lift in sales revenue in the commercial and industrial segment. This was driven by both price and volume growth as we extended our position and prices caught up with higher wholesale prices. And this increase in performance was playing out in an environment where wholesale prices fell by 19% compared to the corresponding period in 2018. Of course, they remain elevated by historical standards. With this in mind, the wholesale team did a good job of maintaining financial contract revenue at similar levels to last year. And financial contracts have more value to the business than might be immediately obvious, as they provide flexibility when times are tough, while enabling the type of growth that you see here. In an absolute sense, they also added 32 million to energy margin, so they remain a pretty important element of what we do. All up, a very strong result in New Zealand, the best we've experienced. This slide provides further insight into the customer team's performance. Our Power Shop New Zealand and Meridian customer teams lifted customer levels, or ICPs, by just under 16,200 across the residential, small business and agricultural segments, while maintaining the average sales price. And as the Electricity Authority has noted, New Zealanders continue to enjoy a highly competitive retail electricity market, so the teams feel pretty proud of this outcome, and we think it continues to be driven by the levels of service and product offerings that the Meridian Energy Centre in Christchurch and the Power Shop call centre in Masterton provide. Second, our wholesale and customer teams again worked well to target high-value opportunities in the C&I market, and as you can see here, the lift in C&I volumes and prices were 39% and 13% respectively. And the majority of those sales are locked in through the next 2 years. In saying this, we realise that there are real Kiwi businesses paying more for their energy as a result of the increase in underlying price. So as I said last August, we continue to work with customers on energy efficiency measures where we can to help offset increases in price. We'd be the first to say that we did not expect prices to stay at these levels for as long as they have. However, having done so for some time now, it's clear that the market is responding by presenting new developments that don't rely on gas, which seems to be the fuel driving much of the volatility and lift in pricing. Alongside decisions already announced by others, we will construct Harapaki when we have certainty and the conditions are right. We had a lot of energy to sell in the interim period and produced just under 7,200 gigawatt hours of renewable energy in New Zealand. This level of production exceeds all comparable periods, and while prices were lower than they were in the same period in 2018, as I noted, they remain strong against our internal metrics and by historical standards. These high prices, alongside the 3-month HVDC outage that limits how much energy we can sell right now, is why we chose to produce those sorts of volumes. And talking of that HVDC outage, as we look forward, we'll obviously be constrained by it through March, but all things being equal, we should have full lakes to power into winter. Looking further ahead again, ASX suggests moderating wholesale prices, FY21 and 22 prices at Otahu currently sit at around $110 and $97 per megawatt hour respectively, and these represent an average decrease of $10 a megawatt hour in prices seen and forecast for this financial year. So moving on to Australia. The Meridian Energy Australia team has continued their growth mindset with over 14,000 electricity and 7,000 gas customers added during the first 6 months of the year. Meridian's PowerShop brand added 82% of the electricity customer growth you see, with the balance largely attributable to Kogan, a white label partner of ours in Australia, which only launched in September. These numbers exceed our expectations, and with Jason Steen now working with that talented team, we expect this to continue. And in late-breaking news, PowerShop Australia was awarded Electricity Provider of the Year by Roy Morgan last week. While not well known in New Zealand, this is a prestigious award and a great accomplishment by that team. So it won't be a surprise that energy margin growth on the consumer side of our business has been pleasing. However, it hasn't been all plain sailing in Australia, and the continuation of the drought that I talked about back in August has taken its toll on energy margin from our generation assets. Production volumes and storage at our Green State hydro facilities have fallen to levels last seen during the 2007-2008 Australian drought. And production levels at Hume, our main hydro generating station, are now 60% below average, and storage is 32% of average. And we have contractual issues at our Mount Mercer wind farm, while Mount Miller is going through a half-life maintenance program. At Mount Mercer, our O&M contractor Senvion was placed into receivership in Germany, and we're working through changes that must follow. In facing this challenge, we've been able to leverage the expertise and experience held in New Zealand in order to mitigate the disruptions that would otherwise follow. LGC revenue, which is recognised upon generation, has seen prices fall from $68 a megawatt hour in the first half last year to $45 a megawatt hour this year. This reduction reflects the expansion of renewables in Australia, and I talked to this fall in price during our August call. Specifically, I noted that Meridian hedged its LGC position and that the value of these hedges would flow into this financial year. I can confirm that to be the case, and we will receive revenue from LGCs that exceed the $30 million figure mentioned in August. So even with the impact of the drought on generation, we're reasonably happy that energy margin in Australia was only $1 million lower than the comparable period in FY19. I will note that if the drought extends, then performance in the second half of the financial year could be challenging. Moving on to costs. First half total operational costs lifted to $143 million. This is an $8 million more than the same period in FY19. As signalled last August, this lift was driven by a growing business on both sides of the Tasman and refurbishment of the Oho chain. And while I'm on the Oho program, total program costs have lifted from $57 million to $74 million. And the program will extend for 1 year beyond the original or initial 6-year term contemplated. The reason for this is twofold. First, the as-found condition of equipment is worse than expected. And second, the scope of the program has expanded so we can push other work that would otherwise have cost $70 million back 10 years or so. As the financial benefits of doing this are positive, we made the decision to increase the scope earlier this year. In August 2019, I stated that for the full financial year, we'd spent between $280 and $286 million after adjusting for the change in treatment for operating leases that flow from adoption of IFRS 16. Having spent $143 million through half year, we're obviously tracking to the top end of this range. If that's where we land for the full year, it would represent a year-on-year lift of $10 million in total costs, and I'll discuss this further then. In August, we also forecast capital spend of between $70 and $80 million for the financial year. Through half year, we spent $32 million on capital items, 24 stay in business capex and $8 million investment, which is $2 million more in total than the same period in 2018. Again, I'll talk to this more when we get to year end. The combination of energy margin and cost produce EBITDAF. And as mentioned earlier, EBITDAF for the interim period was $465 million, a lift of $76 million or 20% on the same period last year. It was supported by New Zealand EBITDAF of $426 million, up 22% on FY 2019, and Australian EBITDAF of $39 million, down 5% on FY 2019. Of course, we need to remember that the adoption of IFRS 16 during the period inflated EBITDAF by $3 million as compared to FY 2019, as lease costs are now depreciated rather than expensed. And some will have noted that operating cash flows only lifted $4 million as compared to the $76 million lift in EBITDAF. The difference is driven by higher tax paid and the timing of working capital items recorded. We can expect cash to be closer to the earnings level by year end. Regardless, it would be superb to double down on this result or deliver the same outcome as we did in FY 2019 in the second half of this year. But as noted, the HVDC outage will constrain performance, so we'll just have to wait and see. For the accountants amongst us, there are a few things to note that this slide captures. First, depreciation increased by 15%, driven by the $1.1 billion lift in asset revaluation that occurred in June 2019. And while derivatives moved net profit before tax around a little, it wasn't substantial, but the lift in net profit after tax and underlying net profit after tax of 26% and 28% respectively are worth noting. Having said this, they both flow from the operating results discussed previously. As for IFRS 16, we adopted the standard this financial year. The impact was relatively minor, with $75 million in finance leases added to the balance sheet. And having stripped operating lease cost out of EBITDAF, that rose by $3 million as compared to last year. Depreciation lifted by $2.5 million and finance costs also lifted by $1 million. The combination dropped net profit after tax by $500,000. Not much to it really. There isn't too much to talk about in relation to the rest of the balance sheet other than to note net debt remains stable even as the capital management program continues. But it is worth letting you know that we will likely come to market later this year for additional funding to support ongoing operations and potentially support the build of Harapaki, but we shall see. So an interesting space for us, strong results delivered in New Zealand. We're executing our way through the 3-month HVDC outage better than forecast, but there's near-term uncertainty in regards to Rio Tinto, and March will be a tough month given the combination of HVDC and Pohokura outages. The good news is our focus remains sound, and we believe we have clear executable plans should Rio Tinto exit New Zealand. We have a superb team in Australia that continues to grow our business while managing through some challenge that renewable companies inevitably face. Our job remains the same regardless. Look for ways to grow the value of the business and improve cash returns if reinvestment does not make sense. Neil, back to you.
Thanks, Mike. The next few slides cover off the latest market developments and political and regulatory policy settings. So we look at wholesale prices. We saw a structural shift in the spot and forward markets that coincided with the unplanned gas outages at Pohokura during the last quarter of 2018. The forward curve has remained relatively high since, and as Mike indicated, we are expecting some moderation in wholesale prices over the medium term, particularly as those new generation projects come on stream. This is clearly putting pressure on retail margins, and prices have lifted considerably in the corporate and industrial segment as customers have renewed their contracts. The impact on mass market pricing is more muted, and certainly in Meridian's case, we take a longer-term view of the underlying wholesale costs, and we're also able to pass through network charges, lower network charges in some regions as a result of reduced cost of capital for regulated lines companies. Now, Lower South Island Hydro spill during November and December has attracted attention, and a claim of an undesirable trading situation, or UTS, has been made to the Electricity Authority led by Haast Energy Trading, who trade energy futures and FTRs in New Zealand. The UTS claimants argue Meridian and Contact spilled more water than was necessary, and that both companies should have priced energy offers at short-run marginal cost while they were spilling. Now, the authority is working through the events, but to put this claim into perspective, I'll make the following comments. 1, throughout November and December, we were dealing with a massive flood event across both of our catchments. And the amount of spill in question is around 1% of the total flow that we managed. Lake Manapuru received the highest inflows on record and Lake Te Anau the second highest. We were dealing with these events without perfect hindsight that the UTS claimants have. And we know from many years' experience that picking weather forecasts, particularly in Fiordland, is fraught with challenges. 2, the notion that generators should offer all of their generation at short-run marginal cost is not in the market rules, and if it were, it would actually be counterproductive to the market objective of incentivising new investments. And 3, the UTS mechanism is designed to deal with circumstances where there has been market manipulation and a resultant loss of confidence in the market. There's been no loss of confidence. Forward prices remained relatively constant, and December spot prices did what they have historically done and fell in line with Christmas demand, as the chart on this page demonstrates. So we're supporting the AA with its investigation into the UTS claim, and we clearly dispute the claim. In terms of demand, spotting a trend in demand is challenging, and irrigation load can swing the overall demand materially. So the chart we present on this slide excludes irrigation volumes. But when we dig into the drivers of demand, we maintain a view of modest organic demand growth. The balance in the system is undoubtedly a little bit tighter, and we believe the outlook is positive, albeit with uncertainty about when the decarbonisation pool will start. All that said, I note that growth observed over recent times has only got us back to the level of consumption where it was about 4 years ago. Now, our strategic aim is to maintain our market share of generation in New Zealand and grow our market share in Australia. And to be fair, we're coming off a low base in Australia. Obviously, we aim to do this in ways that create shareholder value, so we are reasonably discerning of opportunities. Our 160 megawatt Harapaki wind farm north of Napier is close to being shovel ready. During October, we received the consent variations we were seeking and the tender and engineering solutions for what will be the highest altitude wind farm in New Zealand are close to being finalised. Now, as Mike mentioned, we'll put on hold our final investment decision until we learn the outcome from Rio Tinto's strategic review, but it is possible that Harapaki, and it's because of where it is located electrically, will get the green light even if Rio choose to close the smelter. We've been actively working on engineering solutions to get access to the bottom 3.5 metres of consented water in Lake Pukaki. And we've solved the asset constraints, and we're confident now that we can access that water. As such, we've introduced the full consented range of the lake into our operating framework, and that adds 367 gigawatt hours of additional hydro storage to the New Zealand power system. About enough energy to power every household in Dunedin, as it turns out. In Australia, we've purchased a 115 megawatt wind development licence in northern New South Wales, and this should clear final regulatory approval shortly. But it won't be a couple of years until it's ready to be built. More immediately, we're working on a 20 megawatt battery solution to complement our Hume hydro station, which is part of the Green State assets. This will provide us with firming support and further reduce our reliance on caps to manage our retail exposure in Australia. It could also provide us with good learnings, as we think this kind of solution may be a cost-effective way to increase North Island reserves and therefore commercial HVDC capacity in this country. We've recently decided to add people and resources to our renewable development team so we can deliver on our ambition to build a strong and deployable renewable development pipeline on both sides of the Tasman. Now, the increase in resource is not a material cost, but we believe it will create a material lift in our development capability. Looking at the policy and regulatory side of things, there's been some significant movements on a number of policy fronts over the last 6 months. During October, the government decided to move forward on most of the recommendations made by the Electricity Price Review, and whilst I could pick on one or two of the 32 initiatives, we think as a package that they make sense and that overall we're supportive of that recommended change program. Transmission pricing reform remains a hot topic, and it feels a bit like a mirage that wisps away the closer you get to it, certainly in Meridian. But we expect or hope the Electricity Authority will finalise its reform package around the middle of the year. The most recent interesting development has been the authority's consultation on changes to the prudent discount mechanism. The proposal would allow large participants to obtain a discount on their transmission costs if their comparable standalone costs would be less than what they would pay under the existing pricing mechanism. Now, this could be very helpful for NZAS, as there are very few people, if any, who argue that NZAS is not paying too much for transmission. In reality, NZAS have been subsidising New Zealand homes and businesses for years. This prudent discount mechanism needs to be introduced to code immediately to give the smelter owners confidence they will get a fairer deal in the future, and we just can't see why it can't be. There's been two major pieces of legislation progressed by government in respect to climate action. The Climate Response Act was passed into law in November last year with strong bipartisan political support. I think we can be proud of our politicians on this occasion. They've shown leadership on an international stage and done our country and the world a great service. But at the same time, it is a bit disappointing that the fee-based scheme designed to incentivise EVs has been scrubbed, as this is one tangible policy that supported the larger goal. The Emissions Trading Reform Bill is progressing through Parliament, the parliamentary process, and is expected to pass into law by the middle of this year. The bill will enable price signals to emerge that align with New Zealand's zero carbon target. I personally believe that such price signals in a well-regulated market are the strongest tools that we can wield to accelerate clean electrification of fossil fuels and decarbonise our economy. And it's a hell of a lot better than some central planner picking technology winners. Significant proposals for the management of fresh water are a major reform in their own right and have implications for all hydro operators. Key to this is the health of water bodies and a central framework for a new national policy statement on freshwater management. There is recognition within the policy statement of existing large hydro schemes, but with some caveats. Overall, we think the direction of travel is positive for Meridian and the sector, but the reforms are dealing with a complex intersection of climate, environmental, commercial and iwi interests. The work so far represents the groundwork being undertaken for a more significant reform of the Resource Management Act, probably following this year's election. Meridian's near-term imperative is to reconsent the Waitaki chain by 2025, and the freshwater debate is pretty fundamental to achieving acceptable outcomes with those renewed consents. So, the bit you've been waiting for, no doubt. As I explained during our investor call in October, we had been working with NZAS to enhance our contractual relationship in ways that benefited both parties. Meridian had gone to market to test the appetite of other generators to provide support for an enhanced NZAS commitment to New Zealand. We did this before and after the strategic review where it was announced. We've subsequently agreed terms of contact for a more volume at the Tiwai node on better terms than our existing back-to-back arrangements, and we've been able to offer an improved deal to NZAS as a result. There's been little interest from the rest of the sector, so the NZAS offer probably isn't as strong as we think it could or should have been. We have offers on the table for both 622 megawatt and 450 megawatt options. 450 megawatt is an option for the smelter because they face a large upgrade bill in respect to potline 1 of between, we understand, $60 to $80 million, and the smelter owners could choose to retire that potline and avoid the capex. From what we can tell, most industry analysts, some of them in this room, consider the likelihood of Smexit as low. I can't fault the logic, as NZAS is reasonably unique in the high purity and low carbon intensive product they produce, and despite a relatively high cost structure, most of us still model them as being cash positive. But it's not that straightforward. 2 days ago, the smelter reported a $36 million accounting loss for the year. It's also a small part of a large Rio Tinto portfolio, and having met some of the senior Rio Tinto executives, I get this distinct impression they don't understand our nation's free market and non-protectionist approach for large industrials, and they don't enjoy the same level of sovereign support as elsewhere. And lastly, the package of contractual enhancements that we've been able to put together goes nowhere near Rio's request for a third off their current delivered energy bill. So what may seem logical to external commentators may not seem logical to the ultimate decision makers in this instance. What I am confident of, however, is that if Rio decide to keep the smelter operating, they will provide a much stronger commitment to New Zealand through term. We've been very firm that we will only entertain price relief if the effective termination notice period is extended significantly from the 12-month overhang we have today. I'm also confident that the deal we have on the table represents Meridian's point of indifference. Smexit would be disruptive in the near term, there's no doubt, but it would also facilitate a significant restructure of the competitive landscape in both New Zealand's retail and wholesale electricity markets. And whilst the industry has not been keen to wear a fair share of the cost of the NZAS contract, Smexit will force the redistribution of low-cost hydro generation. And beyond that, Meridian's strong brand positions and renewable cost structure means we're well positioned to benefit over the medium to long term. The first tangible mitigation to a possible smelter exit is well underway. Contact and Meridian agreed to jointly fund the early phase of Transpower's Lower South Island grid upgrade. This work was necessary to avoid around 1,500 gigawatt hours of annual spill through Manapori and Clutha schemes that would occur if the smelter closed. Now, we understand work is progressing well on this, and because Transpower have got it going, it is now feasible that the entire program could be completed by middle of 2022. The potential constraint would then move north to the HVDC and Central North Island. Transpower have identified around $500 million of unapproved spend that may be needed before full dispatch of southern generation into Auckland can be achieved. However, this spend may be mitigated to the extent more cost-effective North Island reserves can be procured. The growth in customers on our Flux platform continues, and we're now past 400,000 customers. Our project to migrate the Meridian customer base to the Flux platform is tracking slower than planned, but we've recently reaffirmed the business case benefits and they are as strong as ever. And most importantly, the 60,000 customers migrated to date have all had a seamless experience. So on balance, I'm satisfied with progress. As I mentioned earlier, we had quite a win late last year when we agreed with npower to add a further 200,000 UK customers to the platform this calendar year. In the context of the merger between Eon and npower and the massive cost-out initiatives being contemplated by the merged business, this is a vote of confidence in our platform, we believe. Our job is to demonstrate that the platform can scale efficiently, both technically and operationally. In the context of Meridian's business, Flux remains an interesting proposition for us as it has significant potential upside for relatively modest ongoing investment. So to sum up, we've had a great first half and the momentum is continuing into the second half of the year despite some constraints with the HVDC this quarter. Rio Tinto's decision on the smelter due at the end of this quarter is fundamental, but our job is to ensure Meridian is well positioned to respond to whatever that outcome may be, and I believe that we will be. Further ahead, the government's environmental policy set will lay the foundation for a cleaner energy future, and that I will believe will be made possible by the renewable electricity advantage this country has and few others can match. Thank you. That concludes our presentation. We're now happy to take some questions, and I think we'll start with people in this room in Wellington, our office here, and then we'll go to the phones.
Thanks. Morning, Neil and Mike. Yeah, great result. So I'm sure everyone's very happy with that. A few questions from me. Actually, starting with just making sure I heard it properly, Mike. You sort of alluded to some capital raising for funding Harapaki. Was that right, or is that? And I'm assuming if so, that's more debt as opposed to equity.
It is. Yeah, it is. Yep, you heard me right. And it is debt funding.
Okay, I can relax now.
Yep.
Second question, just around the smelter. I mean, what is your level of confidence around timing sort of before the end of March? I'm sort of aware that there has been some suggestion the offers had an expiry clause towards the end of this week, but yeah, what's your sort of thinking around timing?
Oh, look, we're working with them progressively. They'll give us some guidance as to their timing. They haven't given us anything more than they've told the market, so they're still aiming for an end of first quarter decision. We'll make sure that whatever we've got on the table works with that.
Okay. Next question is just around, I guess, the C&I market, and I know that's been something that you've done particularly well in over the last 12 months or so. And Contact was talking about, and they have effectively exited the market, but looking to come back in now that they've contracted for gas. How do you see that playing out from a competitive perspective and in terms of your C&I book going forward?
Can we cover that?
Yeah. I mean, we tend to run our customer business alongside margin available in the respective segments. And so, we're looking at levels of competition in the C&I space alongside the residential, agri and small business and trying to make the best decisions that we can to increase margin for the business. C&I space, as you mentioned, is becoming more competitive as others see that it's a attractive proposition. So if that played out, you might see us deploy our position in other segments.
Yeah, I'll just add to that. I don't think there's any secret, but we've always said that Meridian historically has been heavily weighted towards C&I, and particularly with the NZIS arrangement, we're heavily weighted to top-end business. And it's our strategic goal to rebalance that weighting more towards the mass market. But we'll assess how the market is behaving at any point in time, and that sort of can drive a push back into C&I if the opportunity is there.
Yeah.
Okay, thanks. Next question is just around Flux, and are you able just to give us any sense of what earnings impact you might get from taking on those 200,000 customers?
Oh, it's in a few $1 million per annum. Yeah. So it's still modest in the scheme of Meridian's profitability, but the growth potential is massive if we're successful.
And second to last question from me, just the drought conditions in Australia and the numbers, the metrics you reported around Hume, is that sort of current up-to-date numbers? I mean, I guess they have had fairly significant rain, and so has it kind of bypassed Hume, hasn't just come over to Fiordland?
So the drought continues for our assets in Australia. As you say, they had localised rain on the coast, but those catchments are inland and haven't received any rain. To give you an idea, on average, those assets produce about 280 gigs of energy a year. This year we'd forecast that they might produce about 180 gigs, given the drought had started some time back. They run multi-year droughts in Australia, and the forecasts that we have now are just above kind of 120, 130 gigs. So you can see how it naturally starts to bite as the kind of years progress. So hopefully that helps.
Yeah, no, thanks for that. And very last question, just I know you don't like giving guidance at all, but when I look at where you're positioned, January was a pretty good month, notwithstanding the transmission constraints that were in place. What's your level of confidence, I guess, that you are going to be looking at a better result in for FY20 versus FY19?
Look, we don't give guidance, Andrew, and we're not going to change that. We do give our monthly operating stats, and you can probably form as good a view in terms of where we're going to end up as we can, to be honest.
Yeah.
Okay, that's all from me, thanks.
Good question, though.
Yeah. Someone had to ask.
Morning, guys. 4 from me. First question, your retail mass market, specifically, strategy in New Zealand, obviously been growing that book for a while. Sort of what's your goal in that space? Continue to grow? And then in a similar vein, if you just sort of reiterate or update us on what your portfolio and sort of strategic goals for Australia around obviously retail and now with a bit of wind as well, just sort of where you see that heading. Third one's a bit of a pointy-head one. It's just to get a feel with the accounting depreciation taking another step up yet again, whether or not there's a large gap growing between the tax cash shield and the sort of the notional accounting one, and how that's affecting the sort of the cash tax side of the business. And the last one, just on decarbonisation, your thoughts on the likelihood of particularly process heat conversion. We had some comments from Fraser Winteray yesterday suggesting that he thought boiler conversion at current sort of, or at the expected sort of ETS pricing would be, break even for a process load would be below LRMC of any of the projects available to electricity generators. Thanks.
Okay, well, I'll probably cover off the first two and then you get the second two. So our retail mass market goal in New Zealand, as I explained, the overarching strategy is to reweight our customer base more into mass market. It just takes away customer risk or customer concentration risk, and the margins tend to be stronger in the long run. We are pushing heavily with our PowerShop brand, so that's our hero brand, if you like, in residential in particular at the moment, and we're getting good traction there. But we'll adapt to how the market operates and behaves. but that's the overarching goal. We don't have any headline numbers that will be satisfied at this point, Neville. It's got to be quite a bit more than what we have today. And in terms of Australia, look, a year or two ago we were talking about, and when we had, I think it was close to 100,000 customers, we were talking about at least quadrupling the size of that customer base. So we want to be to 400,000 to 500,000 in residential customers with a reasonable amount of business load to go along with that. That goal hasn't changed. In fact, we might start to get a bit more ambitious than that ultimately if we continue to track the way we're going. So, yeah, we are looking for a sizably larger business in Australia, and with that will come a need to provide more generation support and potentially firming support with that.
Very good. Hey, on your last two, the counting depreciation versus tax depreciation, I'll come back to you after this. I don't have the numbers to hand, Nev, but your general sense will be right. On decarbonisation itself, I think your comment was the economic value or cost of decarbonising was below LRMC for process heat needs in New Zealand, and we'd agree with that. The obvious rub there is how the price for emissions adjusts and emerges, right? So it's really a trade-off. What's your cost of electricity versus what's the cost that you're paying for emissions that you'd be making for process heat?
Thanks, Mike. Yeah, so I think what that means is that you wouldn't expect to see a rapid conversion of that, at least on pure economics grounds, until we see a much higher ETS price.
Yeah, I think that's right. Nev, we're obviously open to, well, we've been in that conversation with Fonterra and others for some time to get a sense of those economics. We know that the boilers in those facilities have economic lives that extend beyond the next couple of years as well. So there will be some decisions that are made. There'll be both economic decisions and people thinking about their reputations as well, but there are some economic challenges in that space right now.
So I think we've dealt with the questions here, so we can go to the phones.
Thank you, sir. For phone participants, if you would like to ask a question, please slowly press 0 followed by the number 1 on your telephone keypad and wait for your name to be announced. That is 0 followed by the number 1 on your telephone keypad. Thank you. Your first question is from the line of Grant Swanepoel from Craig's Investment Partners.
Morning, team.
Hello, Grant.
First question is just a bit of a try first. You talk about subdued demand growth. You're talking about carbon conversion being low in the medium term. And now you've got all this wind that's coming online. You've got Genesis announcing some solar. You've got Contact probably having that contract with TY change linked to a build of a geothermal. And you guys have just added another 400-odd gigawatt hours to your Waitaki production. So where does this really leave your wind opportunity with oversupply facing the market?
Grant, I think the way we look at it, I mean, we'll look at the project standalone in the first instance. Will it be economic based on our view of forward prices over the term? So is it an economic project today? It's more than likely that it is today. Then we look at the portfolio impacts and the wider market implications. So we do take that into consideration, and that's why the NZAS decision's quite, it will have an impact on the way we think about Harapaki. But the point I made about that particular wind farm is it's electrically uniquely placed in terms of it joins into the 220 kV line that hooks into the Wairaki ring, and that potentially leaves it on the northern side of constraints that will start to develop if if Rio were to exit New Zealand. So it's got an interesting angle from that perspective. We're still trying to analyse that and understand it, Grant, and how that would work with Meridian's portfolio overall. But that's so that's how we're thinking about our particular wind option.
I'd add to it, and it's a good question. It's an obvious question that sits out there, right? But we've modelled this for a long time. Different demand growth assumptions alongside the developments that others have got, all of which we know and everyone else knows. We think there is room for those developments, including Harapaki, and we would note that we expect effectively thermal to renewable conversion to take place. So there will be some retirement of pretty sizable contributors on the supply side over that period that we'd invest. So we think, the energy can be fitted into the energy system effectively, given underlying demand growth and the conversion from thermal to renewable fuels over time. But as Neil said, we've got to be confident and careful of the decisions that we make.
Thanks, Mike. The next question on the Lower South Island link upgrade. While you are indicating that mid-22 is likely the new clean date, is this a binary release of that 1,000 to 1,500 gigawatt hours of blockage, or does some of the project lead to some release at an earlier stage?
You're closest we've got to a transmission expert is
that's right.
sitting at this table.
It is binary, Grant. So there is a complete release of that energy. The majority of the work...
date you use...
Yeah, sorry, go.
Sorry. The date you use of mid-22, I was under the impression that the work program was going to be rejigged and maybe that could be a year earlier, or are you just using the old date at this stage?
So we're using the date that we have signalled publicly previously, Grant. There is obviously potential, if they get good conditions, that work could be finished earlier. And then, as you noted at the end of your question, they might complete components of that work that might release marginally increased energy flows through that area of the grid. But the big upgrade and the value comes from the Livingston to Roxburgh line, right? So that's the line. When you duplex that facility is when you really do release that renewable energy, and it increases the transmission capacity down there from about 600 megawatts on average to 1,200 megawatts on average. So that's the one to look for in terms of timing. And Transpower's, as Neil mentioned, Transpower's making good progress on the work that they're doing to date, and as we're understanding it, not spending as much money as they'd contemplated originally. So things are going pretty well.
Thank you. My final question is on, just to follow on from Nev's question on retail margins. So your retail pricing was flat, and Genesis, been chatting to them recently, they've been bitching that you guys are the ones that aren't passing on the cost of generation, you're cross-subsidising. What is your view on this, or is this more that you're taking a longer-term view on retail contracts?
I don't think Genesis should really be commenting on our pricing strategy. We have our own view, yeah, and Grant, and as I said, we do take a longer-term view of what we think's happening, particularly in wholesale prices, and we reflect that into our retail position. So we've got our own position, we've got our own view of the future, and we price as a result of that.
Thanks for those answers.
Thank you very much. Your next question is from the line of Stephen Hudson from Macquarie Securities.
Good morning, Neil and Mike. Couple from me. Just wondered if you can give us an update on your expected RCP3 savings. I think you talked about something like 26 million annualised from March of this year, if that was still the right number to be working off. Secondly, could you just help us try and size the benefit of the Pukaki contingent storage increase? Obviously, I think that's available only under certain hydro risk curve. So just wondered how we should think about that, sort of the benefit of that increased storage in a mean year. And then just on tax, you've paid roughly your full year 19 number in the first half of 20. Could you clarify whether or not you're expecting to pay any more tax in the second half?
Okay, I'll kick off on the first one. Yeah, no, it's still $26 million, so that's roughly the right number, and it starts to commence from March of this year. In terms of Pukaki storage, it effectively becomes available when we hit the 4% hydro risk curve. And we think in terms of taking the lakes that lower, we would be through that point before we access that water in virtually all cases. So it's just a natural, if you like, extension to the bottom of the lake that's available well before we get to the 10% hydro risk curve, which brings with it retail compensation for customers and the like.
Yeah, and I think as Neil mentioned in his in the presentation, is the value for us is it just allows us to use more water on average from Lake Pukaki because the bottom of the lake has dropped down, and so we get access to a bigger range, which we then use for portfolio purpose. So it's a superb outcome for us. There are some operational challenges, but they're not material, and as Neil said, we've kind of overcome them. Hey, Steve, on your question of tax, I'll come back to you when I catch you tomorrow with an answer to that one. I'll go back to Nev on the counting versus cash or tax depreciation.
No problem. Thanks, James.
Thanks, Stephen.
Thank you very much. Your next question is from the line of Aaron Ibbotson from UBS.
Hi there. Good morning. 3 questions from me, and 2 of them, I guess, are clarifications that I just may have missed. So the first one relates to spilling after the, if we now call it the South Island Link upgrade, which is a preferable name, is done. So from June 22, you mean a scenario where the or has been closed by then. So could you talk about what you think technically it's possible to get to the North Island effectively after that is completed, and maybe if you could say something about the difference between technically possible and commercially likely. You have to be optimistic when you ask these questions. Secondly, and maybe I missed here, further transmission upgrades, obviously on the North Island, seem to be
Aaron, if you can hear me, you're breaking up quite badly at this end. So, but there was a point where you're coming through quite clearly. So, try speaking further.
Sorry
away
about that. I'll shift phones. Does this work better? So, first question is basically regards to spilling in a scenario when the Southern Link is finished by June 22, and if you could split, how much you think technically it's possible to move to the North Island after that is completed in a scenario where the smelter has left, and maybe what commercially you think is likely.
Okay.
Yep. So, Aaron, I think we stated previously, when you complete the Clutha to Waitaki upgrade, that does release all of the energy from both Manapori and the Clutha schemes into the wider South Island. The question I think you have is how much of that energy then can be transported into the North Island, and our analysis suggests that it can all be transported into the North Island, but your question is twofold. One is technically can it be done, and the answer to that we feel is yes, and our analysis suggests that's possible. That what's the commercial effect of transporting higher levels of energy across the HVDC link, and the answer to that is greater levels of price separation between the North and South Island, primarily driven by losses, but also driven by the availability of reserves in the North Island reserves, which is why you heard Neil mention we're looking, obviously, at opportunities to improve the level of reserves and reserve availability in the North Island, because commercially that would reduce that price gap. And, from a commercial perspective, that's what we would like to achieve alongside, technically, being able to deliver that energy into the North Island.
Okay, thank you. And then, and again, sorry if you did mention this, but you mentioned $500 million, which is a number lower than I had in mind, for further North Island upgrades, if I understood you correctly. First, did I understand that correctly? And secondly, do you have has Transpower sort of communicated a timeline, or do you have your own timeline for when this unapproved projects earliest could be completed?
The 500 million is just going off what we've gleaned from what Transpower have said previously. It's all unapproved. Aaron, I understand it's sort of like a 4 to 6 year type program if they got going. So you're sort of talking in that sort of time frame. Of course, it won't progress until we get an understanding of what the smelter are up to, and if they do decide to exit, how long a period they'll take to wind down operations. So all of these things will come into play. But I think, as Mike said, there will be a reasonable delay before the HVDC and Lower North Island constraints can be remediated. So getting commercial solutions around North Island reserves will be pretty key to ensuring we get a good outcome for the country. I think you've gone now, Aaron, completely. I think we might have to kill Aaron.
In your release.
Oh no, here he is.
Sorry?
We've lost you entirely, Aaron.
Okay.
Sorry,
Maybe we come back to you. We try coming back to you.
Thank you. Thank you, sir. Your next question is from the line of Rob Coe from Morgan Stanley.
Good morning, all. Thank you for indulging me in a question about Australia, if that's okay. I just was curious to know your thoughts on the kind of near-term retail competitive dynamic. We now have regulated price caps, churn is down, AGL's been gaining market share, Origin and Energy Australia are reasonably stable, and wholesale prices coming down. Just grateful for your thoughts on how you're going to be sustainably growing in our market.
I think, well, first off, we don't necessarily think regulated price caps, particularly in retail markets, are in the long-term interests of consumers. They probably end up stifling innovation and delivering a worse level of service to customers over the long term. But how we're positioned, and I would expect to see the large players actually starting to cement their positions, to be honest, over time as those price caps stay in place. What I can tell you, though, is PowerShop Australia and our cost structure means that we can comfortably operate at present within those price caps. And so we are making good gains, as one of the charts demonstrated. We're making really strong gains in terms of growing our share of the market. It's a competitive market. The dynamic will change. We'll adapt with that, but we think we've got a unique position in Australia, and we continue to grow there.
Yep. I mean, I'd add, Rob, we do, as Neil said, we've got quite a unique proposition out of Australia, and we did mention the numbers, the growth rates for Australia, and can say that, the numbers for January are superb as well, as people have been challenged, I think, in Australia by some of the near-term realities of changing climate and looking for options like the one we present in Australia to support an entity like ours. So, we see growth out of Australia as something that we can realise given the way we present ourselves to the community in Australia.
Of course, what's happening now isn't always an indication of what will happen in the future, but we do have some confidence that we've got a unique proposition and we'll continue to be successful, provided we're nimble enough to adapt.
Yeah. Okay, sounds good, and wish you all the best with it. Thank you very much.
Thank you.
Thank you, sir. Your next question is from the line of Peter Wakeman. Please go ahead.
Hi. I'm particularly interested in, as we transition to electric vehicles, whether they be private vehicles or trucks, the cost of infrastructure and the necessary substation and additional costs for making it viable for people to actually have electricity. This is the first of the three questions. Do you think the government is sort of wrong to subsidise vehicles when in fact it should actually be encouraging more infrastructure so people can use the electric vehicles without so much trouble when there are areas where it's a bit hard to get charges on the main road?
Look, first off, I'm not going to quote the cost of building out the grid to enable electric vehicle charging because I don't have the numbers at hand, but it's all been modelled and it's still a cost-effective solution, I think, to decarbonise in New Zealand. So that, and I guess my belief or position on it is if we actually start incentivising the EVs themselves, the infrastructures to support them will follow. We're seeing that, if not get there a bit quicker, because we're seeing that in terms of the fast charger network, the way that's been built out in New Zealand. It's actually going forward at a more rapid rate than the growth in vehicles on the roads. Also, the experience from overseas and highly penetrated markets like Norway, for example, is most charging still occurs overnight in the home environment. And there's still plenty of capacity in most of our local networks that will allow the average EV owner to charge their car quite comfortably, and that'll be augmented over time. But you do
what
need
I'm mainly talking about is trucks, heavy users of electricity.
Oh, look, the case for the heavy users is still being worked through. I mean, there's some people think that hydrogen could be a strong solution for heavy vehicles. So I think that will emerge over time, Peter. But I think the real opportunity to get some reasonably strong momentum is in the light vehicle fleet in this country.
Because being such a small market, the cost of the infrastructure, when you look at, say, Tesla with 500,000 orders approximately for a Cybertruck, which has a range of, say, 600 miles. But my understanding is with an EV, you shouldn't really run it below 20% and you shouldn't fill it up over 80%. And then when it's cold weather and hilly conditions, your consumption can, raise, quite significantly. So if you look at New Zealand conditions for an EV, it's pretty cost prohibitive for people to get a top of the range EV if they are on a low income. And you wonder whether the camper van market going EV, if Meridian is really interested in sort of branching out into retail for both commercial and small EV users on well-run tourist routes. What do you say to that?
Yeah, I think in New Zealand, the stats tell us that the average car still runs about 40 kilometres per day. And there's a lot of downtime when it's not running on those 40 kilometres. So, even your Nissan Leaf with 150-odd thousand, with 150k or there or thereabouts, is still, a legitimate option for many New Zealanders in the way they use their vehicles. Now, that will evolve.
Yeah, I'm mainly talking about tourist vehicles, that do high Ks.
Yep, I look at it, it's going to evolve, Peter, and if the right incentives are in place and we can get access to the right types of vehicles, then it makes just so much sense for New Zealand to move to an electric vehicle future. We've got all this renewable energy.
But if you look at the tourist route, the infrastructure is not there for tourist operators to have electric vehicles, and I'm just saying, isn't Meridian missing an opportunity by not sort of trying to step into that area?
Actually, we are installing some charging infrastructure in some of those, or along some of those tourist routes. We've recently installed one in Franz Josef, for example. So we are looking at exactly those sorts of opportunities.
Okay. Well, thank you very much for that. That's it.
Thank you, Peter.
Thank you very much. We have a follow-up question from the line of Aaron Ibbotson from UBS.
So, first of all then, can you hear me?
We can.
Perfectly.
Okay, I'll be very quick. You put in ordinary dividend and capital management update later in 2020 in your release. I primarily want to know why you felt the need to put that comment in there, since I assume you won't tell me what you're going to discuss. Thank you.
I think, Aaron, we were really just saying, we had intended to provide an update on capital management at this session, but for the reasons that we presented, we don't think that's the right thing to do today. So we will, once we know, what Rio's decision is, we will provide the market with an update on the capital management program, and we'll provide you an update on, ordinary dividends as well.
Yeah, we'd promised 2 years out from the scheduled completion of the capital management program, we'd give an update, and that's about now. So we just thought you might hold us to account for that.
Yep. We want to let you know we hadn't forgotten.
I don't think anyone is holding anyone to account over the next 4 weeks. Okay, thank you very much. That's very good, and I like the use of Smexit. Have a good day.
Thank you very much, sir. There are no further questions from the phones. Gentlemen, please continue. Thank you.
Okay, well, I think that's a wrap then. Thank you very much.
Thanks.